Well, it's our great pleasure to have back to the show Rupert Mitchell, author of The Blind Squirrel Macro. Welcome to your first MH Plus.
Thanks, Kevin. I think this is yeah. Edit.
It's going to be a lot of fun. I can tell already. For those who don't know Rupert's been around. He started at Barings. He worked at Jefferies, Citi, Goldman, a Chinese EV car company, and now he writes the wonderfully entertaining Blind Squirrel Macro. And we're going to talk about a couple of things. But the first thing that was on your mind is private equity. And I thought, you know what, a great way to start it would be nothing better than a Charlie Munger joke. So let's give this a listen, because you know good old Charlie and how grumpy he is.
Man has this wonderful horse, and it's just a marvelous horse. It's got an easy gait and good looking and everything. It just works wonderfully, but also occasionally just gets so he's dangerous and vicious and causes enormous damage and trouble and breaks arms and legs for his rider and so on. And he goes to the vet and say, "What can I do about this horse?" And the vet says, "That's a very easy problem, and I'm glad to help you." He says, "What should I do?" And the man says, "The next time your horse is behaving well, sell it." Well, haven't I just described what private equity has to do?
All right, Rupert, do you think Charlie was too tough on private equity?
No, I think he left out the bit about performance enhancing drugs, i.e., EBITDA adjustments.
What can you talk to me about what your experience has been with private equity and why you're a little worried about this cycle? The private, I assume it's more than just private equity. It might just be the private markets in general. Like, what's your concern?
Well, I think private markets has just become code for we mark our own homework and we present this beautiful vision of low volatility returns, which I don't think is true in reality. There was a very interesting report that Dan Rasmussen of Verdad put out the other day with lots of meaty data in there. They had a look at all of the companies that are currently listed that had previously spent time in a private equity portfolio. And I think the measure was whether or not there was still a sponsor owning 30% or more of this business. And he looked at the interest costs over EBITDA for that cohort of businesses. And it was, the percentage was nudging sort of 41% from memory. Significantly more leverage than, equivalent mid-cap companies on the market. And I think that, the point I was making about performance enhancing drugs, there's one, the accounting, and two, the financial engineering that is going into these horses before they hit the broker's yard.
Right. And one of the things that kind of always shocked me about it, and I think it's Cliff Asness has talked about volatility laundering.
Yeah, exactly.
Yeah, and I actually have a couple more clips with Charlie, and this time it's Warren Buffett himself, and they talk about this. Let's play these, and we can kind of comment on these. Here we go. This is the first one. Is good old Warren, Uncle Warren himself.
2 for 1 on that. You may have $3 trillion of buying power trying to buy businesses in a.
Actually, before I start, this is him talking about the amount of the amount of firepower, meaning like the buying power of private equity versus the amount of companies that are out there.
Well, the U.S. market may be something over 30 trillion now, but there's all kinds of businesses that aren't for sale and that thing. So the supply-demand situation for buying businesses privately and leveraging them up has changed dramatically from what it was 10 or 20 years ago. And I'm sure it doesn't happen with your Winnipeg operation, but we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that, they're not calculated in a manner that I would regard as honest. And
one of the things that he's talking about there as well is the fact that a lot of times that when you commit to a private equity fund, you need to actually put aside the money and they don't count your return until they draw it down. So they have this kind of strange
no.
way
It's the IRR calculation, right? So
Right.
I mean, they will. I mean, they'll go to banks and pre-fund investments prior to making the drawdowns, because ultimately that's going to flatter the IRR calculation, because that'll only be calculated with a start date from the drawdown from the LPs.
And this private equity is become so popular because of this thing that we talked about in terms of them not having to market, and the volatility is not in the portfolio. But we both know that it still exists, and yet this is
it's just like saying my portfolio is not volatile because I never open my brokerage account. It is. I mean, it's ridiculous, but I do believe that you've got willing buyers and willing sellers in this game here, because the allocators and the LPs don't want to show volatile returns to their bosses either. So I mean, you've got this fiction, and that'd be fine if it was a niche corner of the market, but it's something like 26% of all family offices majority of family offices globally have got a 26% allocation to PE, and they plan to grow it. I mean, over a third of them plan to grow it in the next year. And then, I mean, I'm not so concerned about the billionaires, but it's pension funds and superannuation funds down here in Australia, and they are increasing the size of their private market allocations simply because they can persuade their customers of the low volatility outcomes. And I just don't think that's true at all. And I think that most of the returns in these portfolios is predicated on very cheap debt, which, frankly, I don't think you or I see as a fact of life going forward for much longer.
Right. And one of the things that I find interesting is that when you go, and I think Dan Rasmussen from Verdad that you mentioned earlier, he talked about the kind of the golden age of private equity when they were buying cheap companies. And there were private companies, and they actually suffered from a liquidity liquidity discount because of the fact that you couldn't buy or sell them. So when private equity was able to come and buy these at a cheaper price than what was trading in the market. And what's so interesting now is that we have situations where there's actually a liquidity premium. People are willing to pay more for stuff they don't have to mark.
Absolutely.
Right. And you see this with the private REITs, which I find just flabbergasting. You'll have a REIT that trades in the market, and then it'll trade at one price, and then there'll be the private fund that has a lot of the same assets on it, and it'll market a completely different price, which is a premium. And nobody's stopping and saying, hey, wait, maybe I should sell the private one and buy the cheaper publicly traded one. The reality is that they would rather not show the volatility, so they pay a premium.
Absolutely. It's complete emperor's new clothes. And what's quite extraordinary is that, I mean, it impacts everything. Now, I've been boring people to death about this topic since sort of midway through last year. And, you can get angry about it, and then you can figure out ways to sort of direct your portfolio towards that viewpoint. And it's quite hard, right? But, I mean, the obvious candidate is to sort of take a look at a sort of a Blackstone or a Carlyle or a KKR and say, listen, I'm gonna take a short position in the in one of these big PE monoliths. But I don't think that works at all, because actually these businesses are in the asset accumulation game. I think they gave up on performance fees years ago. Ultimately the key to that asset accumulation is this low volatility trick. Right. So you're not going to get any surprises. And you, Mr. Calpers in California, or you, Mr. Ontario teachers, are going to carry on allocating dollops of cash to us every single year, because you're going to get no surprises. And even if there are surprises, we mark our own homework. So you're not going to get a surprise. Trust me. And that's so I don't think you can take a bet against those guys. But when you've got the kind of rate rises that we've seen in the last year, this whole game, so the the left pocket, right pocket trade with private assets where they're all selling them to one another. So Blackstone 2 is selling to Carlyle 4, or actually I should probably say Blackstone 32 is selling to Carlyle 44.
Sometimes it's even worse. Sometimes isn't it Blackstone 32 selling to Blackstone 44?
Yeah, financed by Blackstone Private Credit.
Yeah.
Right? Yeah,
right.
let's scratch our heads there. So, I mean, ultimately, what happens when market prices, get to bottom and get to tops, right? There's kind of no liquidity, right? Because you can't print. You can't put something over the tape. So, we're probably in a situation now, and you can see it with how all of the investment banks are reporting, is that there are just kind of no transactions going on, or a very reduced number of transactions, because with the best will in the world, the banks aren't open to, pretend that the money's not all coming from the private credit fund. And so, volumes have gone down. So the way I've chosen to express my view on what's going on in this industry is to take a short position via the intermediaries. Because if you look at what the investment banks are doing, I mean, the monoline investment banks, their business is all about servicing the private equity shops and the hedge funds. On the private equity shops, I mean, when I started in the industry in the early 90s, it was a niche part of the business. If you now look at the big investment banks, what they do with the private equity world is probably nudging on 40 plus % of their investment banking pot overall. So when that business catches a cold, the overall fee-based business of those banks just falls off a cliff, and that's what we're seeing right now.
So what type of banks are you talking about? Like, is that the
so I'm talking about the Goldman Sachs, the Morgan Stanleys. I mean, you have to be careful about the JP Morgans and the Citis and the Bank of Americas, because they've got these big commercial banking operations. Now, it's going to impact them a lot, but it's not going to give them the same kind of negative headwind that you would get with the purer investment bank type businesses.
But don't you worry as well, though, a little bit about like Goldman actually getting a trade right and making money somewhere else? It's
always possible. I mean,
he's got to stop DJing so much, though.
He's got to stop DJing and beware mystique, right? Once you've pulled back the curtain and seen the Wizard of Oz, you tend not to believe in the magic anymore.
Right. So you're convinced that you can't go after the bigger names, like the actual.
Well, I just think what you're doing is you're basically betting against beta, right? You're not really taking a specific bet against the thing that you're worried about. I think these guys will carry on clipping coupons, or in terms of collecting allocations from the world's pension funds and insurance funds, almost irrespective of what's going on in the market. These allocators have 5, 10, 15-year plans, and they decided that they love this low volatility shit, and they're going to carry on allocating it for at least the foreseeable future. There was a terrifying article in I think it was Bloomberg yesterday, or maybe it was the day before, where it was an article about the Australian superannuation funds. Now, I mean, I care, but I'm sure but these pension funds down here are enormous. It's like for a country with 25 million people, these pension funds have assets of $2 trillion, and they are being viewed by the wolf pack of Wall Street as a target rich environment right now, particularly for these private assets. And I do worry. I mean, if you look at the way in which the Australian population is aging now, you've got a lot of these pension funds, or these super funds, that are going to start to go into drawdown mode. I'm worried that they're all going to be locked up in Carlyle 44 and Blackstone Private Credit 54.
Don't you think that's actually kind of the catalyst or the trigger to this problem coming out in the open? Is that when less money is going in that is going out? And isn't that really what we should be kind of waiting for?
Isn't that how every Ponzi scheme fails ultimately? Right? when the money stops coming in. Actually, the other point is, these guys are in the asset gathering business and rather than the performance business. But the other point is, it's probably the most powerful lobby in Washington right now, the private equity lobby. If you think about the sustaining of the carried interest loopholes, you look at all of the interest cost tax shields, all of those PE friendly laws. I mean, until big PE becomes a pariah on K Street in Washington, I don't think you need to worry about those stocks too much.
Well, you could be right. I think it's one of those things that what everyone is sure won't bite them ends up biting them. It's just like housing in 2007. We've never had national decline in housing. Well, we've also never had kind of a point where PE's actually gone down or private markets have gone down. Even this last rally, this last year, I was just shocked at how many people were kind of grinning ear to ear because their privates didn't mark down and they somehow thought that they were up. Like every single financial asset market in the world, marked anywhere from 10 to 30% down. And yet these things somehow marked up and they thought it was real.
Brokerage statements in Barbie land, eh?
Right. And I just...
It's a thing of beauty.
But it seems to me that if you're the smart, shrewd investors have to be looking at this and saying, oh, you know what? The longer I stay in we won't mention a fund, but let's just say there's a fund that's limiting the amount of outflows in terms of the percentage that is allowed to redeem every year, every month. Like the reason that that's happening is because they've seen it and they assume that it's not worth this. And the longer you stay, the more you're getting diluted because you're increasing your exposure in terms of versus NAV.
I completely agree. I mean, and call me old fashioned, but you only have to go back sort of 20, 25 years. The day that an institution gated a fund was the end of that institution, right?
Right.
You did it ahead of an orderly unwind of the business, right? Because that was, the cardinal sin, preventing investors from getting access to their liquidity. And if you ran a business that was forced to prevent investors getting access to their liquidity, you didn't deserve to be in business. And I just don't understand at what point the rules changed.
Yeah. Okay. So your play is you think that this is coming to a head sooner rather than later, but the way that it'll manifest itself first is the investment bankers.
I think it has come to a head, and you can see it in the investment bank earnings. My concern is whether or not that's all fully priced, whether or not we've seen the worst, whether we've seen the worst of the announcements. It looks pretty bad right now, but I don't see any reason for the backdrop. And frankly, this business, the private equity business, only works in a low rate environment, and I don't see a low rate environment coming our way anytime.
Well, let's talk about that. You said you don't foresee us to going back to that thing, and I would argue that the rest of the Wall Street and the rest of the investing world actually does think that. All you have to do is look at the yield curve. All you have to do is look at sentiment positioning. And you see lots of folks that expect us to be, back to 3% or 2.5% in no time. You don't feel the same way?
Well, God, I wish I had the confidence to have a really strong view. But I mean, who's your favorite trader, Kev? Stan Druckenmiller, right? Who's probably the best bond trader on the planet, Stan Druckenmiller. He says explicitly there is no fat pitch in bonds. So I don't understand how everyone is supremely confident that they can have a massive overallocation to the 10-year and just wait for the Fed to cut rates, and they're going to make off like Paul Tudor Jones in 1987. I just don't see that trade. It cannot be that easy.
Well, I think that they've been taught that from 4 decades of lower and lower rates. You're convinced that the tide turned in 2020 and that's no longer the playbook? Well,
I mean, I don't see us getting down to a zero interest rate policy again, unless quite frankly, there's the kind of disaster in markets which none of us are ready for right now. But I take a possibly extremely simplistic view on this. One, I mean, first of all, is we're probably only having this conversation if you kind of have to own developed market rates, right, as part of your mandate. Otherwise, it's a pretty tough trade to be either long or short. But the way I look at this is that if you've all the time that this long duration trade has worked in a sell-off has been with a very different economic backdrop in terms of the health of government accounts in the US. And if you look at a situation whereby interest expense is exceeding defense spending within the next 12 to 24 months, I have to wonder who's going to be queuing up to buy US government debt for 10 years at 4%. I mean, if you think about, frankly, the entire sort of long end of the Treasury curve has been underpinned by Fed buying and QE since the GFC. Who else helps them out there when they've got to, absorb, $700 billion worth of coupon supply between now and Christmas? I mean, if you think about it, I mean, you've got banks who rely on a cheap cost of funding to buy bonds, right? You've got the foreigners. Well, it looks like the Chinese have been selling more than buying recently, and they're the biggest foreign bid for treasuries. You've got our beloved pension funds. Now, I think they buy according to a formula based on their liabilities. I don't think they take a real overweight, underweight position. So are they really going to be making room for Mrs. Yellen? Then you've got asset managers. And if you just refer to the positioning surveys, it looks like they're all pretty full already. So, where does price need to move for them to buy an awful lot more? And then you've got the hedge funds. And, if anyone was reliant on cheap funding costs and sort of dealer balance sheet capacity, it's those guys. So I look at that and I sort of scratch my head. And as a former capital markets guy, I go, I don't see where all the buyers are. And Mrs. Yellen can carry on funding in the bills market, but at some stage she's going to have to test the 10 years and beyond.
But yet at the same time, we have kind of uber bears like David Rosenberg and folks like that saying this is a wonderful time to buy long bonds because the economy is about to plunge. You feel differently?
I mean, why would you? What's your upside, right? If you think the economy is going to plunge, and I have to say, I'm very torn on this whole recession debate. I completely get the fact that there's a rate sensitive part of the economy, whether that's commercial real estate or private equity, that's sucking wind right now, and yet there's a blue collar economy that's just doing fine and might continue to do fine for ages. So, I mean, is that really a crash scenario? When you look at the thing in the whole? Probably not. So what does that suggest? If there is this recession, we're looking at, assuming you think that people carry on buying bonds, where's your upside in yield? Do we move from 4% to 2.5%? So is that a close to double digit gain on your 10-year holding? I mean, that's your upside, but I'd say you were short a lot of vol on the other side. If I'm right.
Yeah, that's a great point. Because not only that, you can earn 5% just risk-free.
Absolutely.
Right?
Yeah.
Like that's the part that a lot of these folks are missing.
So I mean, everyone falls in love with that, Paul Jones in 1987 story, right? That the lightning doesn't strike twice there. I mean, I wrote a note the other day, about the positioning in TLT calls. By the way, TLT's a horrible instrument because...
Why is that?
Yeah, because the thing about owning a long bond is that there is a natural pull to par. The government, I mean, it may be a long way off, but there's a natural pull to par. So the underlying asset should be accreting towards par, ceteris paribus. The thing about TLT is it has a mandate to keep your duration fixed beyond 20 years. So you don't get that natural rising tide lifetime benefit. I mean, it's a nerdy point, but if you want to buy duration, buy a bond that has a fixed maturity, not one that's sort of stuck in the nether regions beyond 20 years forever.
That's right. And people need to understand that if let's say you expected to retire in 20 years and you have two options. One, you could buy a 20-year bond and then you'll definitely get your money at the end of 20 years. Meanwhile, if you buy the TLT, they're going to own a 20-year bond.
And they say, yes, see you in 20 years.
Well, the first year you're going to own a 20-year bond, and then 19, next year it'll be 19, but then they'll roll it out back to a 20 years. So your duration will stay in essence the same throughout that. So your risk will be going up versus when you want it to decline. So you're absolutely correct.
Don't get me wrong. I mean, it's a brilliant trading instrument for retail. But whether it's Hugh Hendry or others, I mean, the positioning around TLT calls right now has got crazy. Now that has to be retail because there are much smarter ways of taking.
I don't know, Rupert. I found like some institutional guys talking about it, and I was like, really? Like you guys can trade futures, you can trade the underlying. You're talking about TLT, and we might be showing our age and be kind of in another world because
it's like. This is like qualified engineers going to a Lego store for their equipment. It's ridiculous.
Okay, so listen, it's been great chatting with you. And we're gonna leave with a little bit of a game, though.
Okay.
And we said that you and I, we're the same vintage. I believe we're born on the same year.
We are.
And a lot of times we share stories and about kind of what it was like to be kind of a teen in the 80s, and we love hearing different things. So what I've done is I've made some clips.
Oh God.
Of
movies or music?
Movies and music.
Oh God.
But they're kind of like crushes that we might have had when we were younger. And you have to tell me who it is, okay? So it can be a band, an individual, or a movie star. They're all going to be female, obviously. So we're going to go through it here. I got how many? 1, 2, 3, 4. I got 5 of them. Okay, so here we go. Here's the first one. Apologize for the technology.
Do you know what? My worst cheese in Trivial Pursuit is the pink cheese.
Well, and yeah, but listen, half of these women you've told me you're already in love with, so we're gonna be okay. Here we go.
Oh, great! Thanks for that.
Sorry for the
it's not revival rock. We're not trying to be 1966. This is 1986, I think, and we're just playing what.
Oh, this is too easy.
I mean,
this is too easy.
Really
don't say it. Let's play the whole thing out, and then you can tell me. Okay. So new rule. You got to let it play the whole thing out. And I'm surprised you found it so easy. I'm shocked.
Well, because it's your crush. It's your crush.
Well, we'll see.
The product of punk rock and the 70s. I mean, that's when we were old enough to really.
Yeah. There's a lot of Casey and the Sunshine.
Buy records. Those were a record buying years.
Yeah. DeFranco family. Yeah. They're hot. Silvers. Yeah. Uh-huh.
Okay. So who is it?
Belinda Carlisle and the Go-Go's.
You're wrong.
Oh, no. Oh, it's the Bangles.
Okay.
I thought it was going to be Belinda Carlisle, your crush.
Yeah, I know. I thought you did think that, and you're saying it's my crush, and meanwhile, we know that how you think. Okay, here we go. Here's number 2.
But she has a very busy schedule. Between movies, she studies at Harvard.
I needed to go to a co-ed environment and a place, where there were graduate schools and a little bit more grown up. And at the same time, my father and grandfather and uncle and a whole slew of people went to Harvard.
So who is that? Who is the actress whose family all went to Harvard and she went there too?
God, I can't believe I don't know because she would have told us a lot.
Think back, it was her big movie. She was the girlfriend of both the villain, and then she switched to the hero.
Oh my God, I'm completely at a loss.
Wax on, wax off.
Oh, the Karate Kid.
Yes,
oh
Elizabeth Shue.
Elizabeth Shue.
Yeah.
Oh God.
Okay, so this next. Sorry, go ahead.
Cocktail with Tom Cruise.
That's it.
That was her memorable movie for me. Okay.
Well, I liked her in Leaving Las Vegas, but that's a
better movie. That's a much better movie.
Yeah, that's a
quality movie.
Yeah. So this next one, when I taped it, all I could think about was Spinal Tap. Literally. Well, let's just play it, and here we go.
Play the torch under your own faces, right? And you get that very brief but very impressive, beautiful but witch-like effect. All right, okay.
I think that's quite obvious. It should just be a feeling of suspense as opposed to people jumping out at you and you having to sort of do
Some of their older videos were a bit like.
The drummer spontaneously combusted. Any idea who that is?
Oh my God, no. Absolutely
the British, and there's a few women.
Pick the accent.
Of course you know that.
I mean, is that Bowie?
No, it's the woman. That was the interviewer interviewing here. I will keep playing it. The interviewer interviewing the women. And they were going on. Let me just get it to the point here.
Play the torch under your.
So let me just get it, and you can hear them here. There she is.
I think that's quite obvious. It should just be a feeling of suspense as opposed to people jumping out at you and you having to sort of.
She's the equivalent of putting a spinach in her pants, or not a zucchini in her pants. You have no idea, eh?
Absolutely none.
I would have thought that would have been a dead giveaway. Bananarama for you.
Oh my God. I didn't really. I listen to really cool music.
Sorry
that I'm not. You've gone completely Billboard on me.
Okay.
I had a sort of Indian goth phase.
Okay, here we go.
So,
you'll get this one.
This
is an easy one.
I think for a lot of people. What kind of pressure is that for you? Is that
Thank you.
I mean, is that has to be some kind of odd pressure because everybody sort of projects their ideal, teen onto you. Did you find that to be a pressurized situation?
Well, it was just funny because I was always trying to be something else. I mean, I guess the success of those movies were just because the characters that I played felt so out of place. And they were always an outsider, ugly duckling and all that. And I guess a lot of people feel that way. So I sort of became the poster child for that.
You got to know that. God, Rupert. Seriously? Honestly?
Our framework of cultural reference.
Yeah, I think we're having some cultural difference with the pond here. Seriously.
Okay. Well, I've got the Breakfast Club.
Okay.
But, she played Molly. She played Molly.
No, she didn't play Molly. That's her name.
Oh, that's her name. Okay.
She played Claire.
Okay,
oh, God.
Molly, dark-haired Molly. Yeah, that one.
Well,
yeah, okay.
It's Molly Ringwald. Okay, and here's the last one. We'll put us out of our misery here.
Oh, God.
Somebody told me.
Johnny Carson.
Maybe they're putting me on. One of the things you want to do is raise, you know what I'm going to say?
Pigs.
Miniature pigs.
Pigs, yeah.
Now, if you were on 20 Questions, the older What's My Line, and came on, and people had to guess, I want to raise miniature pigs, that would have been the last thing I would guess. Why?
Well, I grew up with a lot of friends who were in 4-H, and they had pigs and sheep and all that kind of thing. And I always felt an affinity towards pigs.
You're giggling here.
Okay. So who is that? Well, you got it the first one. You got it on the first one.
Oh,
yeah,
Belinda Carlisle. Okay.
And it is my crush. All right. So I'm sorry to embarrass you.
Oh,
it's like my games are not working. When I did Morris, he didn't get that many fish songs backwards. And this, I completely underestimated the problems with the pond between us.
Not really. I mean, I'm not on the pub quiz team for the sports and entertainment questions. I'm just
but you
not.
are on the macro. You are on the macro team when it comes to answering and helping out everyone with your great letter that is free. People should go sign up on Substack. Why don't you tell us where they can find you, where they can find the letter, the whole 9 yards.
Okay. You can find it very easily at blindsquirrelmacro.com. I am on, do we have to call it the X app at Squirrel, at Squirrel Macro? Let's see how long that man-child allows that business to exist. But yeah, I'm still on there for the time being. And just welcome as many readers as I can get. So come and find me there.
Yeah, it's as I said, it's free. It's awesome. Rupert talks about numerous things, whether it be grains, bonds, stocks, and what I like best about it, and I've told you this before, is that you'll actually put your positions, your option trades. You'll go through the ideas. It's a terrific letter. I highly encourage everyone to go and sign up. And I just want to thank you again for your time, Rupert.
Thanks, Kevin. Such fun.
Take care.
Take care.
Bye-bye.
Bye-bye.